After a near uninterrupted rally since July 26th, that saw most major global equity indexes gain over 10% and the US dollar fall 5%, the markets have taken a deep U-turn since Friday last. The reason for the U-turn is the upcoming speech on Thursday by Fed Chair Jerome Powell at Jackson Hole, the annual central bankers meeting. So what is the market expecting from Jerome Powell? What's the base case? What's the best case and the worst case? And how will all this impact currencies, rates and equities? I have with me two experts to decode that. Jahangir Aziz, Head of EM Economic Research and Commodities at JP Morgan, and Stephen Englander, Global Head of G10FX Research and North America Strategy at Standard Chartered Bank. Gentlemen, thank you very much for staying up for me. Well, Steve, let me come to you first. And it's a common question to both of you. What is the base case in terms of what Jerome Powell will say, but what's the best and worst case?
Well, there are two ways of answering that. One is to say, is he going to be hawkish, talk about how they're going to fight inflation and get it down to 2%? The answer to that is yes. If in market terms, though, the question is he hawkish relative to what's priced in? And given the market moves over the last couple of days, it may turn out that, even a Fed chair who's hawkish by, in absolute terms, ends up being less hawkish than the market, which has become very pessimistic in recent days. So, what I think he's going to say, and this is my baseline, is that obviously that they're determined to get inflation down. They'll take rates where they have to go for as long as they have to go to do it. But what I also think he's going to discuss that the evidence that the economy is slowing, and also say maybe indicate that they're going to slow down the pace, that there are risks to going too fast when you don't exactly know the correct model of the economy, so you might overshoot, and that's something that the Fed really doesn't want to do. So I think I think most of the Fed, there are some exceptions such as Bullard and Waller, but most of the Fed, I think, believe that you're worse off if you do stop and go, if you hike too much and then you have to cut.
So what you're saying is the Fed may actually. 1 minute, Steve. What you're saying is the Fed may actually say that they don't want to run too fast. Yeah.
Okay. Yeah, that the downside from or the upside from shock and awe and credibility isn't worth the risk of the downside of stop and go. Yeah.
Well, if they actually say that, then that might be dovish for the market. Jahangir, a similar question to you. What is your base case expectation?
So I'm somewhat different from what Steve said. I think, that given the last two payroll reports, I think it is very hard for the Fed to walk back and say that the labor market is showing any signs of slowing down. I think given that, you already had a minus, a 1.2% annualized first half growth rate, chances are that the economy in the second half, at least that's what we believe, is going to perform better than in the second half. So I think both on the growth front as well as on the employment front, it is going to be hard for the Fed to say that there are signs of slowing down. The slight 9.1 to 8.5% decline in inflation isn't going to move the needle at all. So our sense is that the Powell is going to say what I think has already been telegraphed by the other governors and the FOMC members, which is that the Fed will continue to raise rates, and he is unlikely to show his hand whether it's going to be 75 basis points or 50 basis points, but will continue to raise rates till there are legitimate signs that the economy is slowing down. And by that, I think the Fed will focus on both the labor market and the inflation rate. And the inflation rate will probably come down because of energy price slowing down and food inflation coming down. But it's really the labor market that the Fed will focus on until there are direct signs that the labor market is actually showing signs of producing an economy where wage growth isn't going to run the pace at which it is run. I think the Fed, the Powell is probably going to hint that pace of rate hikes will have to continue.
So, Jahangir, this is the tougher question. Would you therefore say that Powell may not necessarily stop the correction that's happening in the market?
I think there is a sense that what you've already seen from the other Fed members, FOMC members over the last 2 weeks, that I think at one point in time when the rally was taking place, I think there was a sense that the Fed's message wasn't getting through, and I think that the Fed will want to correct. There's an opportunity for Chairman Powell to correct that sentiment in the market that the Fed is actually not in any time in the near future for any pivot in his Fed policy. I think that message, I think he will try to make. Related to that, I think also there's a question of what he says on QT. I don't know whether he's going to say anything on QT, but we would need some more clarification in QT would be helpful at this point in time. So I don't know whether he's going to say that. I mean, clearly the market is more focused on the interest rate part than on the QT part, but I think the QT part is important for the bond market.
Okay. Well, Steve, to come back to you on the market impact, if the Fed is, as you say, your base case is that it may hint that it does not want to run so fast that it will have to walk back later, it will have to waver. In that case, markets may actually find some succor, you think, after the Thursday speech?
Short term, yeah. I believe it's on Friday, but either way. But short term, I think yes, because I think the markets have gotten pretty panicky pretty fast. But at the end of the day, it's going to depend on the data. I mean, if the unemployment rate keeps falling, it's going to be tough for the Fed to slow the pace of hikes, but we expect that the unemployment rate will begin to pick up, and we think that the U.S. is going to go into recession. So we think that they will get the evidence that they need, and get it by Q4, so that they'll be moving much more slowly from then on.
Fair point.
If at all.
So we have clearly different points of view in terms of expectation. But Steve, given the economic evidence and what we know about Fed members, do you think the dollar at 105 or 104, I think it went to, has kind of bottomed? Do you expect the dollar index to climb more from this current 108.5 levels?
Yes, but not much more. There's more going on than the Fed, by the way. I think that the concerns about COVID in China, the obvious concerns about energy in Europe, all of this is leading to an environment in which the market says, well, the only place to go is the U.S. and the U.S. dollar. But we don't think that it's going to go up that much more. We do think that it's going to slow down. And we think that there's also an awareness that the strong dollar is causing issues for the rest of the world. And if they can, I think that they would take measures to prevent it from going up very fast without compromising their inflation target, if that's possible. So I think we're not at the top. We're close to the top, but there's still room for the dollar to go higher.
Jahangir, now to come to emerging markets, there has been an inflow of foreign funds back into the EM. They were deserted for several months, but in the past 1 month, we have seen flows improve. Do you think that will continue, or with the reversal of dollar strength and a hawkish Fed, we are once again going to see funds desert EMs?
I think it clearly will depend upon, what the impact of all of this is on dollar strength. So in general, when the U.S. economy is doing well and the world is doing well, you can have interest rate hikes by the Fed, but that does not necessarily translate into dollar strength. In June and July, when we did get the very excessive dollar strength, it was because of a risk-off environment where fears of a recession had basically engulfed the global markets. But if you compare, the first half of this year with the second half of this year, what we expect is going to happen in the second half of this year, we have to remember that in the first half of this year, the two of the largest economies in the world, the U.S. delivered on an annualized basis, minus 1.2, and China delivered 0 growth rate. The world actually was run on European growth and emerging market ex-China. And I think that is probably going to reverse. In the second half of the year, we do expect the U.S. economy to go from that minus 1.2, not very much, to about 1.5, but it is a move upwards. And the Chinese economy, regardless of all the fears we have about the Chinese economy is going to go from around 0 in the first half of this year to about 7.5% annualized rate to get you about 3%, year-on-year growth. But the second largest economy in the world is going to go from 0 to around 7.5 in the second half of the year. Against that, we have European growth actually slowing down and probably going into recession in the fourth quarter of this year, basically because of the rise in natural gas prices, and emerging market ex-China also slowing down appreciably because of the impact of the almost a year-long increase in rate hikes that the emerging market ex-China has seen, not in Asia, but in Latin America as well as in Europe. So I think growth is going to go up in the second half of the year, but it's going to be again a context where growth is going to rotate away from emerging market in Europe towards US and China. So in this environment, it is likely to be the case that you are going to see dollar strength, perhaps not so much against CNY, but clearly against emerging market ex-China as well as against Europe.
Do the flows come, Jahangir? I mean, because Indian market has benefited a lot from the last 1 month of flows.
No, the flows come in specific emerging market countries that are able to withstand the dollar strength. That most likely going to happen. If the dollar strength isn't very large, then the flows come. But if you do get another bout of very excessive dollar strength, then no, I mean, emerging markets cannot take capital flows in the face of dollar strength.
Steve, what's your best guess? I mean, do we once again see the flows deserting? I'm more specifically asking if there is a very good chance that the rupee will go above 80.
We think there is. We think it's going to go to 80.5, and actually end Q3 at 81. It's a tough position. The balance of payments is very difficult, even with oil prices having come down. And, it looks like there's some burning of reserves there that in the long term may not be tenable. So we do think that the rupee is at risk. Probably not more so than much of EM. I think that the situation of where we are, weak growth and rates going up and inflation fears dominating, is not a good one for emerging markets.
That's right. Actually, 80.5 is not at all disaster for India. Jahangir, just that final question to you. Crude has come now to double digits. Do you think that continues? And your call on dollar rupee?
So we do expect the crude prices to continue. So the energy market will be divided up into European gas prices, which will probably going to go up, and global oil prices, which probably going to stay at these levels or probably trickle down a little bit more. So given the fact that the big consumers of gas of oil are probably not going to grow as fast. On dollar rupee, doesn't almost all of that depend on what the RBI does. I mean, look, I know this sounds, will sound strange, but the RBI in 2020 and 2021 probably accumulated about what, $125 billion of reserves for a rainy day. This is the rainy day. So my sense is that what happens to the rupee almost entirely depends on where the RBI decides to use up those reserves in defending the rupee, or it doesn't defend the rupee.
Okay.
Flows are not going to be such that that the rupee is going to be will continue to remain under pressure given the flows. Current account is going up. Capital flows are not going to be able to reverse that. So almost all of it depends on RBI. I mean, basically, are they willing to use the $120 billion of reserves that they accumulated in 2021 to defend the rupee?
Got that. Okay, gentlemen, thank you very much for staying up for me. The key takeaway, there is a difference in opinion in the market. The Fed may not be that hawkish as the market is fearing. On the other hand, Jahangir feels it could be. We are in for an interesting Thursday and Friday. Thank you very much for watching this edition of It's the Economy. Chartbusters up next.